Hey, what up, y'all? It's your boy Degenerate coming at you July 2nd, 2019. Today, I want to talk to y'all about game theory, what I've been learning about it this past week, why it fascinates me, and some of the resources that I've been listening to. I'll link below. If there's anything that you'd like to add to it or you'd like me to learn more about and talk about it, just let me know. Comment below, give me a call. Let's talk about it. I'm fucking in. So the first thing that got me interested in it was this professor at Yale that was talking about if the smart move, like you always have, you're playing a strategic game, just straight up. You are in a market that is a strategic. There are wrong moves and there are right moves, and your market is an infinite game, and the idea that there's never any winners at all. You can only lose. You cannot win. Like Warren Buffett has not won the game, even though he is probably the richest investor period. He still hasn't won the game. He's old and decrepit and like sorry. But it's infinite in that you can lose when you tap out by not having the resources to play. So that's number one. The only way that you lose the game, like this is the game that you're playing, and you only lose it by just tapping out. Like, no shit. And in the futures market, it's very much zero sum, and the idea that my gain on a trade is coming from someone else's loss. Like when I put that I want to buy a futures contract in the future, someone is also telling me that it's worth it to them to short that contract at that exact price, and that's how we make a deal. So when I'm gaining money, they're losing money. When I'm losing money, they're gaining money. Of course, they can sell it to a different party can take it over. That's where open interest comes in. If you don't know about that, it talks about how many open contracts are on the market in total, not contracts that have been closed. The CME futures talks about their open interest. Every futures market talks about their open interest. If it interests you, if you want to gauge where the market's going, it does have some value. If you're at a brand new high and you see a lot of new contracts open, probably a bunch of shorts. If you see a lot of contracts close, and it's probably closing their longs, just think rationally about it. But anyway, the only way that you can lose this market game is by not having the resources to play. So you should always choose the course of action that benefits you the most, regardless of others' actions. You could think about it as, if you wouldn't buy this right now, maybe you should sell it. Because you always gotta assume, even though the market is irrational, you gotta assume that whoever you're playing against is just as smart as you. That's why they've saved money. That's why they can get into the market. Because they're equally fucking smart. They're genius, for all you know. And there's some math behind it. Some people create models to exploit their value, like the value that they're deriving. They're just trying to exploit it to meet their risk objectives. If it does that, they're going to run an algorithm to make it happen. And that's where high frequency trading comes in. Now that I've got that idea with game theory, let's go ahead and look at the fucking chart. We hit almost 14K. Damn. Look at that alert. Yeah. Anyway, this is what we're looking at here. This is a weekly chart, and your volume profile is right here. It's looking a lot more full in these areas. The 6,000 to 4,000 area looks like it kind of got skipped over. So we could totally come back and fill this area on the chart for real. There's nothing to say that we won't. And we may come down here to 1,800, 2,000 to 1,300 and fill this area. But I kind of doubt that. But 6,000 to 4,000, yeah, sure. Currently, we are in an uptrend. And what are you going to do with that? You're going to buy the dips until you no longer are in a clear uptrend. And look at this right here. This weekly close looks like shit. Like this, if you've never seen a doji, let me pull candlesticks. There's a gravestone doji. This is bearish as fuck. And that's what this is right here. So with this, if this weekly closes below 10.3, 10.4, 10.2, whatever the fuck, the farther away it closes below this, the more bearish it is. If you would have looked at the daily, you could have shorted back around 12.6, around 13, wherever you wanted to, for real. But the second I saw this start coming down, I was like, cool, the high is 13.9. I shorted at 12.7, and I said if it breaks 13.9, I don't want to be in this short anymore. So I'm holding it, and I'm going to use that to fund my future concept. And I think that that's what game theory is about. You're trying to protect your risk of failure. You're trying to identify a trend early. And you want your concept just justified in as many ways as possible. While not running out of resources. So with game theory, people will talk about going to the end of the game and reworking your steps back there. Which, without math, that's really difficult. Like, I'm having a really difficult time with it, for real. But from what I am understanding is ahead of time, identify where you will hedge or where you will take profit or where you're going to set a stop loss. Whatever you're going to do, work it out ahead of time. Up until this past couple days, I thought a 3-to-1 reward to risk ratio was great. Now, I'm thinking I want to have a 4.5 reward to risk ratio for me to take a trade. Personally. And I want to pyramid my trades with future concepts. So the idea of that is that if you're already trading with the trend, okay, if you long something here and when it pulls back, for instance, say like my example, if like you're longing 10,000, and you reach your 4.5 R. Say this is going to be your low, and that's your first take profit at 12.3. So here, you could sell 33% of your trade. And you could take 1.5 R off the table. Your stop loss, first, and I'm still working through this, so don't nail me to the cross or anything. But if I'm protecting against the risk of failure and I'm trying to identify this trend early, I'm going to sell 33% here at my first take profit. I'm going to have 1.5% that I gained total account, and I'm going to use that for a future bet, preferably when it dips. So I'm really your take profit should only be at areas where there are high clusters of trades. So when you're looking at the weekly here, like where's the high cluster up here? Like you don't really have none. You have one at like 13.9, obviously. But is there one at like 12.3? No. If you're being honest with yourself. But hypothetically, you would take 33% of your trade right here, and you would use that 1.5% to then go in the same direction as your current trade. Wherever it pulled back, wherever you decided to re-enter, that's up to you. Wherever your stop loss is, that's up to you. But you're only going to max risk with trading fees 1.5%. And the flip side is your other remaining 66% of your trade is going to be moved to a 2.6 R. That's going to be down here, back at 11.3. So if that gets stopped out, you still have 1.5 R left on the table to fund a future model. Now, if you're at 12.3 and say you enter in and it keeps going up, then you're now pyramiding successfully your trade while mitigating some risk. You didn't enter all in on your account back down here, but you now have more of your account long going in the direction of the trend than you would have if you just would have left this trade alone. So every percentage that it gains after that second long, or after your third long, or after your fourth long, you can identify as many targets as you want to in the future and take profit on whatever makes sense to you for your trading plan. But for me, at 4.5 R, it makes sense for me to just drop 33% of that trade and raise the rest of my trade to a stop loss at 2.5, 2.6, whatever, so that I'm taking home 1.5%. And if it comes all the way back down to my original entry, fuck it, you can re-long it if you'd like. And if you decide to split up this 1.5% that you got from up here, if you decide to only risk 3/4 of a percentage longing it, and you want to spend the other 3/4 of a percentage doing whatever the fuck, if you want to build it as a model for shorting altcoins or longing altcoins or longing USD coins, or you want to have a high leverage other trade on a different asset, that's up to you in your trade. But I don't think there's any rules other than managing your risk that is important at the end of the day. You should always rebalance when you have overwhelming risk. So if that involves moving your stop up, do it. At the end of the day, the only thing that you shouldn't do is tap out because you don't have the resources. So just continually make sure that you have those resources to play against tomorrow. That's all I can stress, and I hope you build a reasonable concept off of that. While I'm here, if you are longing this, I'm longing this. If I was looking at places to long, it would be 9350. It'd be 8500, right around here, based off of this shit. And it'd be 7700 if it comes down here, because of well, all of this right around here, all of this right around here, and all of this right around here, and then also 7000. And if you're also doing 7000 because of this line, if that breaks, you should also do 6400. And if you're doing 6400 or so, maybe you also want to do 5300. But with that said, all of these trades, with trading fees, with slippage, I'm not going to lose more than 10% of my account building this model. And if the bottom isn't all the way in, down until 4,000, you're still buying 2 or 3 Bitcoins for the price of 1 Bitcoin right now. So, who's the real winner? I think it's you. You own more Bitcoin in the future, and that's not an inflating supply. It's hard money. Anyway, trade safe, manage your risk, don't run out of resources to play.